everyone and welcome to ECO232. In this video, we will be covering chapter 2 of the module where we will be looking at key terms. National accounts. So a national account is a system of accounts used to describe macroeconomic indicators of the economy. In essence, the sum, composition and distribution of aggregate output. Aggregate is the word macroeconomists use for total. Economists studying economic activity in the 19th century or during the Great Depression had no measure of aggregate activity on which to rely. So they had to put together bits and pieces of information to see what is happening to the economy as a whole. It was not until the end of World War II that the national income and product accounts were put together. In South Africa, most of the national income and product account variables are available from 1960 onwards. The South African Reserve Bank publishes the national accounting data in its quarterly bulletin, which can be found online. And then this is just an example of the national income and production accounts of South Africa. So the summary of gross domestic product, expenditure, and national disposable income. And then this is the governor of the South African Reserve Bank. GDP, production, and income. The measure of aggregate output in the national income account is called the gross domestic product, or GDP in short. So GDP shows the market value of the goods and services produced by labor and property located in South Africa. So for example, consider an economy composed of just two firms. Firm 1 produces steel and Firm 2 buys steel, produces and sells cars. So like we said, Firm 1 is a steel company and Firm 2 a car company. Firm 1 produces steel, employing workers and using machines to produce the steel. It sells the steel for 100 Rand to Firm 2, which produces cars. Firm 1 pays its workers 80 Rand, leaving 20 Rand in profit to the firm. Firm 2 buys the steel and uses it together with workers and machines to produce cars. Revenue from car sales are 200 Rand, and of the 200 Rand, 100 Rand goes to pay for steel and 70 Rand goes to workers in the firm, leaving 30 Rand in profit to the firm. So the three ways to think of GDP. Number 1, GDP is the value of final goods and services produced in the economy for a given period, usually 1 year. Number 2, GDP is the sum of value added in the economy during a period, usually 1 year. And number 3, GDP is the sum of incomes in the economy during a given period, usually 1 year. GDP is the value of final goods produced. Imagine the two firms become one. So let's say Firm 3, and it is a steel and car company. The revenue from sales will be 200 Rand because we're looking at the value of final goods produced. We don't add the 100 Rand because steel is an intermediate good in the car making process. An intermediate good is a good used in the production of another good. So once we count the production of cars, we do not want to count the production of the goods that went into the production of these cars. And this motivates the first definition of GDP. The wages will be the 80 Rand and the 70 Rand for the workers, which equals to the 150 Rand, and then leaving Firm 3 with a profit of 50 Rand. GDP is the sum of value added. The term value added means exactly what it suggests. The value added by a firm is defined as the value of its production minus the value of the intermediate goods used in the production. So in our two firms example, The steel company does not use intermediate goods. Its value added is simply equal to the value of the steel it produces, which is 100 Rand. The car company, however, uses steel as an intermediate good. Thus, the value added by the car company is equal to the value of the cars it produces minus the value of the steel it uses in production. So it's 200 Rand minus 100 Rand is equal to 100 Rand. So the total value added in the economy or the GDP equals to 100 Rand plus 100 Rand, which is equal to 200 Rand. And this definition gives us a second way of thinking about GDP. GDP is the sum of incomes. So far, we have looked at GDP from the production side. The other way of looking at GDP is from the income side. When we go back to our example and think about the revenues left to a firm after it has paid for its intermediate goods, some of the revenues go to pay workers, and this component is called labor income, and the rest goes to the firm in the form of the capital income or profit income. So of the 100 Rand of value added by the steel manufacturer, 80 Rand goes to workers, which is labor income, and the remaining 20 Rand goes to the firm, which is the capital income. And then of the 100 Rand of value added by the car manufacturer, 70 Rand goes to labor income and 30 Rand to capital income. So for the economy as a whole, income of the workers equal to 150 Rand. So it's the 80 Rand plus the 70 Rand. And then the income of the steel company and car company equals to 50 Rand, which is the 20 Rand plus the 30 Rand, and the sum of incomes is equal to 200 Rand. And this motivates the third definition of GDP. So to summarize, you can think about aggregate output or GDP in three different but equivalent ways. So number one, we say GDP is the value of final goods and services produced in the economy for a given period, usually 1 year. Number two, GDP is the sum of value added in the economy during a period, usually 1 year. And number three, GDP is the sum of incomes in the economy during a given period, usually 1 year. So due to time constraints, I have to cut this video here. However, I will make part 2 of chapter 2. Thank you.